Good morning. Happy Friday. It's 9 a.m. here in Hong Kong, in Shanghai, and in Beijing. Welcome to Bloomberg Markets China Open. I'm David Ingles. Let's get to your top stories today. Stocks across the Asia-Pacific trading sideways and flat. That's as we head into the Lunar New Year break with Korea. You have China shut today and an early close for markets here in Hong Kong and also in Singapore. Treasuries are poised for a weekly drop. Now, SoftBank surging again in Tokyo, bolstered by a massive jump in shares of its crown jewel asset, chip designer ARM. And of course, we hear exclusively also coming up here from the CEO of Korean financial giant Shinhan about buffering their billion-dollar exposure to risky U.S. property. Welcome to the show and hope you're all well. And yes, that's me and him. We just come back, of course, from Seoul, and lots to talk about there. Markets there, by the way, are shut, including markets in Taiwan, which should be up and running at this point in time. Mainland markets are shut as well, so everything from cash markets, commodities, onshore yuan, stock connect programs. Southeast Asia, Philippines, and Vietnam. And speaking of Southeast Asia, Singapore is going to get up and running in a couple of minutes, if not now, but we are also headed there. And also in Hong Kong for an early dismissal across these markets. Hope you're all well. Last session, year of the rabbits, enter the dragon, as they say. There we go, 0.8% to the downside, 28 minutes to the opening bell. Lot to talk about today. So we talked about the Nikkei and, 38,000, right? 37,000. We talked about earnings. SoftBank, bottom of your screens coming up very, very soon. I think we were up 9% yesterday. A further 12% today, unsurprisingly so because of that sort of exposure they have to ARM, which was up 50% overnight. Flip the boards, please. We're looking at currency markets, dollar, yen. That's also helping. The fact that we're still trading near, if not at, year-to-date highs on that. We're up, 4 weeks on the dollar. Dollar China, of course, we don't get a fix today. So just bear that in mind in terms of the lack of anchoring, if you will, lack of liquidity too. Aussie dollar in focus. You had comments coming out of the RBA today. This is one of the bottom of your screens. Rate hike hasn't been ruled out yet. It's also, of course, the opposite is also true there. Commodity markets, we're focused in what's happening with oil markets, algo trading. You have the prospects of maybe no ceasefire in Israel, Hamas. They're sending, I guess, some of these algos buying up oil. Hence, we're trading at, 76, 77 in West Texas, 82 on Brent. And very, very quickly, we talked about global treasuries on track for a weekly drop. We're tracking high across APAC bond yields, and your U.S. 10-year is just about trading at these levels, still near the highest going back to late last year. All right, so let's put everything together for you. Last session of the week, Paul Dobson's with us, our executive editor, joining us to talk us through. Paul, what's top of mind for you today? It's quiet, though.
Yeah, it's quiet. Not so many markets open. And yet some interesting stuff going on already for us today. We had some calls for more rate hikes in New Zealand by ANZ Bank, and that seems to have pushed the New Zealand dollar stronger across the board, particularly against the Australian dollar, where it's the highest in several months now. A little bit of a divergence in interest rate policy there that people are latching onto. I do think, although mainland China's markets are closed and we don't get the FX fixes you were just discussing, that's also going to be interesting to watch how the UN trades today and then through next week as well. And also the shortened session in the Hong Kong market can still be interesting given all the volatility that we've seen in equities over the past few weeks.
That's interesting. Can we talk more about that, the currency, the fact that we don't have a fixing for today, which has arguably that's been unchanged at 7.10, I think going back to mid-December. Does that open up maybe weakness ahead, at least for these next few hours, Paul?
Yeah, I think that there's a possibility that we'll see the CNH, the offshore traded yuan, under pressure. probably a little bit more volatile during the holiday season. I think that in general, the yuan is really interesting at the moment. The PBOC is in a little bit of a bind here because if it allows the currency to weaken much beyond sort of this sort of 7.2 level, which seems like a line in the sand, then the risk is that it accelerates the capital outflows, it undermines some confidence in China. But at the same time, at the moment, it's kind of semi-pegged to the dollar, which has been appreciating. And so that's lifting the yuan against all of its other peers as well, which is hurting efforts to revive the economy. Within that as well, I think, potentially the authorities might like to reduce interest rates further, but again, that would accelerate that sort of downward pressure on the yuan. And one other factor to watch is the Japanese yen's role in all of this as well, which has itself been weakening quite significantly since the start of the year, with the BOJ still kind of pretty carefully minding its language around the possibility of a rate hike there. So we got the yen close to 150 against the dollar, also weakening against the yuan as a result of that kind of pegged thing, again putting pressure on China's ability to compete for exports in the international area. So quite a lot of different cross currents there buffeting the currency at the moment. It's going to be interesting to watch, and particularly without the anchor of the fix for a few days, we'll see where that goes.
Right, and with a tailwind coming off a stronger dollar, 4 straight weeks now, Paul, and you mentioned the possibility of further rate hikes ahead. I mean, who would have thought we'd be having that conversation at this point? And the reason I bring that up is Tom Barkin out of the Richmond Fed, talking about how the data in the U.S. has been just remarkable. Just talk to us about the implications here in the Treasury market today. What's the conversation there among your team?
Yeah. Well, this week we've seen strong auctions, and yet we've also seen slightly higher yields in the Treasuries market. The good news is that all that supply was taken down. We had a record size for the 10-year. No problem. There was demand for it at these yield levels. But remember, we've seen quite a big jack up since the start of the year in the Treasuries market as well. If you're still listening to the policymakers and surprised when they say, yeah, we're minded towards easing later in the year, but not yet, then you haven't been paying attention, because I think we must have heard that from about 30 different policymakers right across developed markets in recent days and weeks. But on the other hand, and that's the tension, the economic surprise index for the US is the highest in several months. We keep getting these beats. We keep getting these beats in the jobs numbers. We keep getting these beats in the inflation readings. We had the really strong wage growth as well. So plenty of pressure still on rates and on the Treasuries market, pushing those yields higher.
Paul Dobson in Singapore for us, our executive editor for Asian markets, laying out really just I guess markets can hope. They are hoping for cuts. Policymakers have been reminding us, hey, not that quickly, right? Inflation's still an issue. Florian Netto's here with us, head of Asia multi-asset at Amundi, to talk us through which side he believes. Good morning, and nice to see you.
Good morning, David.
So central bankers have said, hang on a minute, we're not going to cut as quickly as you guys think we will. Markets have obviously priced 120 basis points of cuts has been priced on Fed fund futures. Who's right here?
No, but for sure, when you were mentioning about the fact that U.S. growth is very resilient. We've been having a labor market last Friday, overnight as well. Yeah. We get jobless claims that is a bit lower than expected. So we have a strong labor market. We have a strong data in the U.S. that is coming. ISM has been strong. So basically, the market has been pricing the probability of a no landing. That has been increasing. So the number of cuts has been postponed down the road. The Fed has been pushing as well. FOMC members have been pushing towards we have time. And indeed, they can afford to wait with the growth inflation mix, and when we look into the financial conditions that are relatively benign. Then what we think is that they will eventually have to cut. They have a bit of time to monitor the inflation data. They just want as good inflation data as we got. So they don't need better. They just need to be a bit more confident about the fact that inflation is coming back down. And I think March is close. It means that May or June is live, and we believe that they will start with potentially 50 basis cut, and when they are starting, they will keep on going.
Why 50? 50's That's a strong signal if they move by double.
Yeah, I think they have been waiting for a long time. They have good growth for now, but when we see the underlying of the economy, we see cracks. When you look into regional PMI data, it has been a bit decelerating. Everything we look into the labor market, you see some cracks in the early hours as well.
Yeah.
When we look at the earnings season in the US, for example, you see that companies are actually doing a bit lower than what we were expecting on the last quarter, so the surprise is a bit lower. And at the same time, when we hear about the guidance, about the comment of the CEOs and COOs, they are talking a lot about cost cutting. We have the news about the commercial real estate that is getting a hot topic in the US.
Yeah.
Janet Yellen has been mentioning about the non-bank lender overnight. So I think all this together means that they may have to cut. And we believe that on the quantitative tightening side, it will come to an end this year. So this is our central scenario. FOMC Logan has been mentioning about this in January. The Fed has been confirmed last time at the FOMC that they will eventually discuss about the quantitative tightening. We believe they will phase it down and they will eventually come to an end.
So treasuries at these levels, cheap, very cheap?
Treasuries at its level, cheap medium-term point of view, direction of travel for yields is down, for sure. Then cheap over the short term, we believe we have to be tactical in this environment. We got a lot of primary markets this week, relatively well digested, but you see that at the end of the day, yields are averaging slightly higher. We believe we are in a trending range. In this trending range, we will play around it. But we like to have duration in our portfolio, and we think on the medium term, you should be long duration in the US.
Okay. What about U.S. equity markets? What's the implication there? How much exposure do you guys have at this point?
We have good exposure to U.S. equity. We have been light in U.S. equity, too light last year, and we have been building confidence, seeing that earnings have been better than expected. We don't expect earning recession anymore. Earning expectation in the U.S. has been coming down. When we look into companies that are able to, most of the time, meet the earning. The bar was low coming in the earnings season, but we see that technicals is good, positioning has been improving. So all this is telling us that risk are in the US in terms of concentration of the performance. And you can see overnight, again, everything that is AI related has been performing still very well. Some companies will have the bar too high to meet this expectation, and with high multiples, they will suffer. So that's why on the tech, we are very selective. But in general, we see good business model and we see good prospect for US equity for this year.
Well, what about APAC equity markets? Which market do you want exposure to?
Well, APAC is our preferred areas where we see the better opportunity going forward. We are quite selective. We like Japan, we like Korea, we like Indonesia. So Japan, quickly, there is still juice left in Japan. Why? Because we believe that moving from deflation to inflation is a game changer for Japanese corporates. Earning expectation is 10%. We see buybacks are coming in. Yen, we don't think the yen will appreciate. So we are quite confident there is some juice left, even if it's not as cheap as it was. Korea, we're seeing the value up program that has been announced as quite
They've been talking about that. They want to get rid of this discount.
Exactly. So I think it's quite promising because they want to do the same as the Japanese the Japanese program. Low PB companies can eventually be more focused on shareholder value, and that we think this is quite positive. We see eventually export coming back in Korea and upcycle in semiconductors. We have been waiting for it for a long time. So seeing growth quite strong, inflation coming down. Shareholder values that can eventually come back. Korea is nice. Indonesia is satellite trade, smaller market, lower foreign exposure, but it's perfect for green transition because you have amply commodities. China +1 strategy. Growth is around 5% for this year and next. Inflation is already back to what Bank of Indonesia is having in mind. We are seeing very much good prospect for Indonesian equities going forward.
You've outlined interesting criteria there. 5% growth, low PB. You can say that about China.
True.
But
I think
there's a
on
but
China,
coming. But
well, I think in China, if you want to follow all the headlines, and I'm sure you're following it, we have been having a slew of markets stabilizing headlines. So what we have for now is sentiment is getting a bit better. We have been touching, I think, a low point last week with margin trading outstanding collapsing, with volume very elevated, with northbound flow negative, and eventually with all the slew of different market stabilization program, sentiment is better. Mainland stocks have been finding a bottom. Now, do we think it's sustainable? We don't think it's sustainable at this stage. What do we need in China? Do we need a better macro momentum? We don't think we need macro momentum for Chinese equities to perform. What we need in China in terms of catalyst is definitely a large coordinated fiscal easing targeting demand. So this is what is missing. What we have is market stabilization, but it's not tackling the fundamental issue of the Chinese economy today. So we need something targeted toward demand. We've seen a headline on consumption and how to make sure consumption is improving via subsidized or potentially tax breaks on automobile sectors or housing appliance. This can be a very strong signal from the authorities to lead to a more sustainable rally on the Chinese equity. And definitely foreign investor will step in because it's value, as you said, and we have good business model. What we need is a better sentiment as of today.
Okay, so I guess we're waiting. Florian, nice to see you, and happy Lunar New Year to you and your team. Florian Neto, there, of course, head of multi-asset Asia at Amundi. Now, just ahead here, speaking of, we'll try and get the thoughts also of Mark Mobius. He's joining us in a couple of minutes here to talk us through where the money will probably head in this Chinese market, leaving for now, where does it go, and his changing investment strategy. Counting down to the open of trade, the last one in the year of the rabbit, here in a fairly cool and cold and fairly wet Hong Kong this Friday morning. Futures are pointing lower. This is Bloomberg Markets China Open. Good morning.
You can feel the stress in the commercial real estate area, particularly, of course, downtown office. So that's a real thing, and the banks, many banks and non-banks have exposure. It wouldn't stun me if, a bank or two ended up wrong-footed in those things. But the system knows that real estate is a, asset with a certain amount of risk, and I hope and expect that, we've got enough capital to weather that.
Welcome back to shows. That was Tom Barkin, Richmond Fed president, talking about the risks to the financial system stemming from real estate. In fact, just on that very topic, Treasury Secretary Janet Yellen says that U.S. regulators are also keeping a close eye on risks they're facing, these non-bank mortgage lenders. She spoke at a Senate Banking Committee hearing.
FSOC is very focused on that because non-bank mortgage companies lack access to to deposits which banks have. There is concern that in stressful market conditions, we could see the failure of one of these.
Our Asia investing editor, Russell Ward, is with us out of Tokyo this morning to talk about this. So, Russell, what's the concern about these non-bank lenders, and how serious could this problem be?
Good morning, David. Yes, I think just as the clip showed there with Janet Yellen, the concern really is with these non-banks, of course, they can't accept deposits, so therefore they rely on short-term funding to make their lending, and that's very volatile. That could easily be pulled at short notice in times of stress. She's not saying that we're in a time of stress now, but if there was, there's the potential for, one of these more non-bank mortgage lenders to fail. So. There's concern that they're having a greater role in the financial system and that they could destabilize the financial system in times of stress. And so sort of looking at the bigger picture, regulators in the States are looking at designating non-bank lenders, or at least some of the larger ones, as systemically important financial institutions. And so that will increase their regulatory obligations. And it really sort of reflects a broader tightening of the non-bank sector, not just mortgage lenders, but also hedge funds, private equity firms. All firms in that space are being subject to more regulatory scrutiny and obligations.
Just to pivot here, this is one of our top read stories right now. Of course, Janet Yellen warning about this. The other top read story, unsurprisingly so, is on hedge funds, perhaps with this new SEC rule, needing to share a little bit more, at least with regulators, their strategies. What do we know about this new rule and what the implications might be?
Yeah, so this rule is all about, hedge funds potentially, on a confidential basis, I must add, will have to share information about their strategies, their exposure, their counterparty risk, etc., to regulators. And really, what's behind this is regulators want to know really more about the hidden risks in the financial system, understandably, and also understandably, perhaps the hedge funds are against this, they're opposing this. They say that sharing this information risks, jeopardizing the confidential information on their strategies. It would also raise costs for their at the asset owners who are their clients. That's pension funds and endowments, and so these costs will filter down into ordinary people. So that's the counter argument. But certainly regulators are concerned that hedge funds they're playing a much larger role in the financial system in recent years. They become much bigger and more complex, and really they need to know these risks in order to sort of plan and keep an eye on the stability of the financial system.
Russell, great stuff. Thank you so much. Russell Ward, their Asia investing editor for us in Tokyo. Okay, there's a couple of things ahead of the open, 9 minutes away, so my mistake, my bad. There is a midpoint for the day to fix us out of the PBOC. We're looking at 710, so that's largely unchanged from where that's been almost daily going back a few weeks or so. That's about 850 pips. Just in terms of the variance from estimates. Number two is out of the PBOC2, there's also open market operations coming in today. So they're selling, well, net, they're selling about 120 billion RMB. That's between 7 and 14-day notes, same rate there, so no big change there. So that's a net injection, all things considered, of just over 50 billion RMB in open market operations. Right, so 8 minutes to the opening bell in Hong Kong and futures, and some of your early pricing indicates, quite a nasty drop, actually, today. So we'll get to that in just a moment here. Other big stories we're tracking at this point in time from around the world. Russian President Vladimir Putin says that his country has not achieved its objectives in Ukraine yet. That's as the war nears its 2-year mark. Speaking to the Tucker Carlson network, Putin said that he would consider negotiations only if the U.S. stops supplying weapons to Kyiv. Now, it's the Russian leader's first interview with a Western media figure since he ordered the invasion back in 2022.
If you really want to stop fighting, you need to stop supplying weapons. It will be over within a few weeks. That's it. And then we can agree on some terms.
Meanwhile, Chinese President Xi Jinping has told his Russian counterpart that they need to work together to oppose foreign interference. In a phone call between the two leaders, they also talked about how they said that they would promote joint energy projects despite sanctions led by the U.S. Relations between Xi and Putin have grown in nearly 2 years since Russia launched its invasion of Ukraine. Okay, plenty more heads. A preview of the final trading session of the week and of the year of the rabbit. Futures, as you can see, are pointing to a weaker open south of 1%. This is Bloomberg. Right, good morning and welcome back to shows. So before we certainly refocus our attention in a couple of seconds back to markets, it's the last trading session, last day here at the Rabbit. So sending you all my love, my team's love, of course, and thank you for joining us all throughout this year. You're watching Bloomberg Markets China Open. Right, okay, back to markets this time, and certainly, hopefully, the year of the dragon, enter thee. Brings more prosperity, at least as far as markets go. We're looking at weakness, though, across Hong Kong benchmarks. Mainland China shut, by the way, today. Just keep that in mind. So no connect programs. You do have the fix, which came in today. Open market operations out of the PBOC. They're taking out some money out of the system here. We're also, by the way, in the window for potentially the release of January credit numbers. So the windows from Feb 9 to Feb 15, and of course throughout the period, that's mostly a public holiday in mainland China. As you can see, though, at the open, weakness just about across the board. And as far as market breadth is concerned, that's also certainly what we're seeing, fairly negative breadth in the opening bell. 1.7% to the downside on the HS Tech Index. So just looking at how the discrepancy between, at least on variance, at least between these benchmarks, it's certainly a weakness across the growth and tech, large cap sectors are concerned. A couple of stocks in focus, not a lot of big themes today. I mean, certainly we're looking at energy counters on the back of this popping oil prices, 81.5 here on Brent, though certainly the dominant theme has been weakness, and that's not enough to even offset the weakness we're seeing. Well, at least the strength we're seeing across other energy counters. Geely Auto, Li Auto, reason we have those in there, those are actually the two best performing stocks in the last 5 days or so. So I guess in many ways underscoring the fact that we are getting money taken off the table right now going into a long holiday. Trading volume, just keep this in mind. So this was yesterday, and I would imagine given the shortened trading session today, it would be generally more busy than usual, given just the pronouncement we've seen recently as well. So trading volumes are back, and as you can see, the moving averages are also pointing to the fact that we are getting more activity coming through. We're also looking at chip makers here, by the way, and in case you missed it, in the small chance that you missed it, let me phrase it that way. There we go. Big move overnight. When do you see a stock this big move that much? 50% up overnight in ARM. Strong results. Suffice to say, the guidance maybe met expectations here. Some of the chip makers listed in Hong Kong and Japan, just have a look at how we are doing across those, and maybe there's a read through here. Not a lot, to be completely frank, although certainly in Tokyo, one of the big movers is SoftBank because of ARM as well. Okay, speaking of 50% higher in New York and ARM, AI spending helping boost, of course, the designers' forecast, the chip designers' forecast, and the CEO told us that the remarkable opportunity presented by AI is still in its early stages.
This is really the results of strategies that were put in place a number of years ago that are now just really starting to come to fruition.
Yeah. When we think about the vindication, when we think, though, still about basically more of your technology going into more types of equipment, you've managed to see a diversification out of phones. Paint us the strategy of ARM going forwards, because many would say, actually, you're not just, well, the overall designer of chips, you're basically making the chips. You're fabless in some way. How do you see that relationship going forward with Qualcomm, for example?
Well, a lot of folks, as you said, didn't really understand the company well and where we fit. And obviously, we had a lot of growth attached to the smartphone market. But ARM is in a lot of devices that people may not naturally think about. We're in a Tesla vehicle. We're in a Ford F-150. We're in a Ring smart camera. We're in a Samsung TV, a Samsung smart appliance. So just about every device you can think of has ARM inside. And just about every device you can think of needs more and more compute, particularly as AI is now driving a whole new demand cycle.
Talk to us about AI. Jeffrey is really signaling that out, the analyst there, saying that this really shows you're a beneficiary from AI. But where does the AI focus come? You, of course, were at NVIDIA before. They are all about AI accelerators. And I'm interested as to whether or not that would be an area that you get into other than servers.
Well, right now, NVIDIA is a great partner. Their Grace Hopper chip, the super chip, uses a lot of ARM CPUs in combination with their GPU, which is a really, really great solution for high-end AI training in the data center, as well as inference. But when you start moving to smaller devices, say smartphones or PCs, well, AI is going to run there too. If you look at some of the recent announcements by Samsung and Google relative to their smartphones, there's a lot of things such as circling an image on a browser and then having that browser go off and do search based on the circle. That's AI. That's actually running in a smartphone. And what we're seeing is really a drive for more and more compute capacity to run these AI algorithms, some that people don't even know what they are yet. But what designers want to do and need to do is future-proof their designs with more and more compute. And that is really driving a strong licensing cycle for us in terms of more demand.
Yeah, there we go. The CEO of ARM speaking with our Bloomberg Tech, of course, there, Caroline Hyde and Ed Ludlow, just on the back of just mind-blowing conversations and obviously what happened with the stock there. Speaking of something that's going against the grain and certainly statistical aberration, check this out. There we go. Recession lows, massive plummet at the open, these benchmarks. And I can tell you right now, I'm just glancing at my terminal, virtually every single stock is down on these major benchmarks, 2.5% now on the HS Tech Index. So certainly, what did they say? Value emerges when price drops. What are the opportunities in this Chinese market? And broadly speaking, across EM. Joining us now to talk us through this, you might know him. His name is Mark Mobius. He's the founder and CEO of Mobius AI Investments. Mark, good morning from the Asia Pacific, and thanks for joining us. My producer handed me the sheet of all your titles. You have this, founder and CEO of Mobius AI Investments. You're now also an advisor to Hong Kong-based asset manager Chartwell Capital. Mark, let's start off with that. Tell us about this new gig.
Well, Chartwell, as you know, is a really leading manager in Asia, and particularly in Hong Kong and China. They've been doing a terrific job. And I think they're going to see some good opportunities now because the Hong Kong market, as you can see, has been driven down to very, very low levels. of course, it could go lower, but we're now beginning to see people make comparisons with India and China and Hong Kong, of course, and beginning to think, hey, maybe India has gone too far up and there's an opportunity for Hong Kong, China side stocks to perform. I'm not predicting that, but I think people are beginning to look at the valuations. I'm beginning to think that perhaps there's going to be a good opportunity there.
Well, what meets your criteria, Mark? Because you tend to have a very stringent, of course, netting out process and figuring out what's value. I'm wondering, does anything meet your criteria at this point in Hong Kong? And also, what criteria do you use? Price to earnings or something else?
We use return on assets, return on capital to begin with. They're very important. We look at, of course, the EPS growth rate, and we look at debt. We like companies with the low debt. I would say those are the three big things we are focusing on. Of course, we look at hundreds of other variables, but those are the three that we are really focusing on. And now some of these stocks in China and Hong Kong are beginning to meet some of those criteria.
Right. Yet it's not been enough to attract, the large, you would know, Mark, the large foreign institutional investors that have largely kept their distance from this market. And despite everything that tells us this market is cheap on valuations and it might rally on the policy pronouncements and stimulus, it doesn't seem to move the needle. And I'm wondering, you've watched this market for a long time, Mark. I'm wondering whether you think there's also a messaging issue here on the part of Chinese officials to global markets.
Oh, there's no question that the Chinese officials are trying their best to regain confidence, get people to be confident again. But you must remember, at the end of the day, it's the Chinese investors who drive the Chinese market, not foreign investors. So the first order of business will be for them to instill confidence in the Chinese investors' minds. But I think that will eventually come once this housing problem is over. It'll take some time, but as you know, most Chinese investors have a lot of money in their property, more than in stocks. So if the property situation gets better, then I think you'll see money from the Chinese investors going into the market. And I think Chartwell would probably be able to take advantage of that since they're sitting there in Hong Kong and watching developments.
Yeah, active, of course, and yeah, very close to the action. Mark, so tell me this then. So you hit the nail on the head. You have two issues which will likely be with us in some form over the next year or years. Property market and, of course, with the lack of inflation in this market. What do you think amidst those two things that will remain a feature of these markets, what do you think the appropriate investment strategy or exposure would be to China given those two things?
I think the appropriate strategy would be, first of all, keep an eye on U.S. interest rates because and they're coming down. They're going to be coming down. The Fed has already said they will. And that will be positive for emerging markets generally and for China as well, because one of the problems is the higher interest rates that the Chinese property investors have to face. So I think that's something we have to look at the end of the day. And we will probably see that happening probably by the end of this year, beginning of next year.
Mark, just want to get your thoughts and make the case for EMs. U.S. markets continue to outperform. And I'm wondering what the case would be to do the opposite, Mark, given just everything that's been happening in the U.S. Can't seem to find, that market can't stop rallying.
That's true. The U.S. market has been terrific. And, of course, U.S. fixed income has been great. At 5%, foreign investors find it very lucrative to be in their own market. But as I said, when markets perform is when the interest rates come down. And I think that's going to happen. And emerging markets will be the first to benefit. But you must remember now that emerging markets are very different. And if you look at the Indian market has outperformed the U.S. market. And, of course, it's outperformed the MSCI Emerging Markets Index. So there are a lot of things happening. I'm here in Brazil, very interesting developments in terms of lots of infrastructure. Of course, oil, they're drilling oil and pumping oil at an increasing rate. And then I'm headed for Argentina. And as you know, Argentina in the dollarization program is instilling a tremendous amount of confidence. So you may see these markets begin to perform again.
Okay, well, I was going to ask you, does it make sense, Mark, and I probably know the answer based on what you just said, does it make sense at all to buy an EM index, or is it nonsense?
I wouldn't buy the EM index. I would look at individual markets and do it that way. Of course, you know, the EM index has underperformed so badly, and it's because of China. Once China begins to perform, then you'll see that happening. You may want to buy an index ex-China for the time being, but again, you have to be careful because China may pick up and then you lose that opportunity. But I pick individual stocks to begin with.
Right. You mentioned India. Just one question on that, if you will. Elections are this year, and do you think that bull market continues agnostic of who's in charge of India?
Yeah, I think that's the word, agnostic. You've got to really look at the individual stocks, individual sectors. And of course, technology is the big winner right now, and will continue to be going forward.
Okay, talk to what so you mentioned you're in Brazil. Some interesting things there in the energy sector. What's piquing your interest in Brazil at this point, Mark?
Right now, believe it or not, even though the oil is flowing very nicely in these deep wells off the coast of Brazil, we are interested in technology, software companies that are using technology in one way or the other. It's really amazing to see how even the central bank here in Brazil has created a digital payment system. And that means that they're really on top of the technology spectrum. And that's going to be very exciting going forward.
Mark, as always, a pleasure to speak with you. And of course, yeah, enjoy your time in Brazil. The carnival's in town, I believe, I heard. So just in case, enjoy that too. Mark Mobius, founder and CEO of Mobius AI Investments. Right, plenty more ahead. We'll get you an update of these markets that are, well, firmly, just look at my skin, firmly on the back foot. There we go, 2.3% to the downside as we speak. This is Bloomberg. Good morning and welcome back to shows. We'll take you straight back to Japan. This is in Tokyo, and you're looking at, well, this is in Parliament, where the Bank of Japan governor is speaking with, lawmakers right now, just underscoring a couple of things. That, well, the BOJ will consider negative rates if the price goal remains in sight. So, in other words, normalizing policy, number one. That the possible outcomes and the finances could worsen temporarily at the exit. So that perhaps it talks about how what they plan to do with this enormous amount of security they're sitting on at this point in time. Financial conditions, Governor Ueda had said a few minutes back, will be easy even after negative rate ends. So keep in mind, even if they do move from negative rates to slightly positive rates, that's one and done, according to the BOJ governor, and of course many people that we talk to as well share that view, and that financial conditions, there we go, will remain easy. Okay, we'll leave it there for now. Dollar yen, although on the stronger side of things, still at the very weak end of the trading range so far on the yen against the dollar so far this year. Now, let's pivot away from Japan and have a look at South Korea, because even after inflation there has actually slowed for a third month, Shinhan Financial, that's the Korean financial giant, believes that the BOK will actually be more cautious in its easing policy approach. I spoke exclusively with the boss, their CEO, Jin Ok-dong, about the central bank's rate path and the impact that higher rates have had on the real estate sector.
The market is calling for a fairly early rate cut, but we are actually predicting that it will probably be later than that this year. Still, I think we're going to be in an environment where we're going to see one rate cut in the second half of this year. But I don't think the Bank of Korea is going to take an overwhelmingly fast step. Rather, I think it will take the stance where it takes a slower tempo than the US and other countries. For example, if the US cuts interest rates, the BOK will probably take 1 or 2 steps longer.
From the bank's perspective, are there certain industries where you think repayment pressure becomes a problem this year, and do you think default rates start to come up across those sectors even more from current levels?
The biggest victim from high interest rates in Korea is real estate. When real estate prices were rising, a slight increase in interest rates could easily be covered. But now that it has stopped rising and has returned into a partial decline, and the gap is reversed, as high interest rates are maintained, it can be seen that real estate developers and builders are in a very different situation, and the decline in their ability to pay interest is a burden on the Korean economy.
Is the worst ahead or is the worst behind us?
I think we're in a phase where we're looking for a landing spot. The liquidity issues and the bad debt issues of the SMEs have been largely covered by provisions over the last year and a half. A year and a half ago, we were actually quite concerned that this was going to turn into a systemic risk in the financial sector. But now we're seeing that this slowed down over the course of a year and a half, and we're not expecting any kind of bankruptcy crisis or default crisis in the SMEs.
Exposure to U.S. commercial property. Do you have any material exposure to U.S. real estate? Should we be worried?
Fortunately, in the banking sector, we actually had enough domestic funding needs that we didn't have that need to invest in overseas real estate. So we have very little exposure in commercial real estate in the U.S. right now. However, among our group affiliates, insurance and securities have some small positions, but even that is not a big number, so we think it is manageable. In Japan, there was no domestic demand for funds, so a lot of money flowed into U.S. commercial real estate. But in Korea, there was a relatively high domestic demand for funds, and there was not a lot of money flowing into U.S. commercial real estate. So I think that part is manageable.
Speaking of those specific positions and exposure you have, are you expecting any, whether that's a provision or to, a need to re-rate some of those assets, for example, in terms of the financial impact, potential financial impact?
Our overall exposure to U.S. real estate is about 2.4 trillion won, and I think the risky tranche amounts to about 1.4 trillion won. For the 1.45 trillion, we've built up about 20 billion won in provisions, and for the 1.4 trillion tranche, we've built up about 20 billion won in provisions. I'm thinking that's probably going to be managed within that.
There you go, the most good-looking man on financial TV. And David Ingles. There we go. All right. Let's get you some other corporate stories that we're tracking at this point in time. Bloomberg has learned that Goldman Sachs is under investigation here over whether it improperly charged fees for futures trades. Now, sources say that a U.S. regulator has sent subpoenas for information about these transactions. It's the latest regulatory headache for the bank, which paid $50 million last year to settle at least 4 CFTC cases. Now, ExxonMobil plans to leave Equatorial Guinea within months, ending almost 3 decades of oil drilling that made the country an OPEC member. The small West African nation became one of the world's hottest provinces around the turn of the century, but output has since dried up along with foreign investment. Right, some stories we're tracking there, plus markets doing this as we head into the weekend. And, well, we'll see what happens. A breakdown of what's going on underneath the hood coming up next. This is Bloomberg.